On July 9, 2025, the United States imposed a punitive 50% tariff on Brazilian imports, a sharp escalation from a previously announced 10% rate. This decision, however, diverges sharply from conventional trade policy justifications. The US has maintained a consistent trade surplus with Brazil for over a decade, rendering the typical rationale of correcting a trade imbalance inapplicable. Instead, the tariff is overtly political, framed by the White House as retaliation for the prosecution of former Brazilian President Jair Bolsonaro, a political ally of US President Donald Trump. The economic consequences of this policy are significant and multifaceted. The tariffs target key Brazilian exports that are staples for American consumers and industries, including coffee and beef, threatening to increase retail prices in the US. For Brazil, while certain sectors face severe disruption, its broader economy demonstrates resilience due to its relatively low dependence on the US market and its deep, expanding relationship with China, its largest trading partner. The US tariff is poised to accelerate Brazil's strategic pivot towards China, strengthening a partnership that spans commodities, infrastructure, technology, and finance. This move risks alienating a major Latin American economy, potentially undermining US influence in the region while inadvertently bolstering China's strategic and economic footprint. In July 2025, the Trump administration announced its intention to levy a 50% tariff on Brazilian goods, set to take effect in August. This represented a dramatic increase from the 10% baseline tariff announced in April 2025 and positioned Brazil to face one of the highest US tariff rates globally. The move sent shockwaves through the Brazilian economy, particularly given that the US is its second largest trading partner. The primary justification for the tariff is not economic, but political. The White House explicitly linked the measure to the prosecution of former President Jair Bolsonaro, who faces trial over an alleged coup attempt following his 2022 election loss to Luiz Inácio Lula da Silva. President Trump has characterized the legal proceedings against his ally as a witch hunt. The administration's ire has also been directed at Brazilian Supreme Court Justice Alexandre de Moraes, who is overseeing the investigation into Bolsonaro. The White House accused Brazil of politically motivated persecution and actions harming US companies' free speech rights, a likely reference to Justice Moraes's court orders requiring social media platforms to remove accounts spreading disinformation. These tensions culminated in the US imposing sanctions and a visa ban on Justice Moraes and his family shortly before the tariff announcement. The political motivation behind the tariff is underscored by the bilateral trade balance. Unlike most trade disputes initiated by the Trump administration, this one cannot be justified by a trade deficit. The United States has consistently run a trade surplus with Brazil for over a decade, which stood at $7.4 billion in 2024 on approximately $92 billion in total trade. This fact has been repeatedly highlighted by Brazilian officials, including President Lula, to counter the US administration's claims and expose the political nature of the tariffs. The tariffs, while containing nearly 700 product exemptions, are set to impact billions of dollars in trade and inflict economic pain on both nations. Key sectors of the Brazilian economy are facing significant disruption, while American consumers are likely to face higher prices for essential goods. The trade relationship is characterized by a complementary rather than competitive structure. Brazil primarily exports commodities and semi-finished goods to the US, while importing high-value, technology-intensive products. Brazil's exports to the US. In 2024, top exports included mineral fuels and oil 7, 96B, iron and steel 5, 72B, machinery 3, 65B, aircraft 2, 69B, coffee 1, 94B, and meat 1, 07B. These goods are often essential inputs for US industries or staples for American consumers. US exports to Brazil. The US sells advanced manufactured goods to Brazil, including transportation equipment, industrial machinery, electronics, and chemicals. For instance, Brazil is a major buyer of US fertilizers. The tariffs are expected to directly affect the cost of living for Americans. Coffee. Brazil is the world's largest coffee exporter and the source of 30% of US coffee imports. With global production already squeezed by climate change, replacing Brazilian coffee will be difficult and costly, likely leading to price hikes for American consumers. Beef. The US is the second most important market for Brazilian beef, a sector that had been expanding rapidly. Tariffs will make Brazilian beef less competitive, and while some supply can be replaced by other countries like Argentina and Australia, prices for products like ground beef are expected to jump sharply. Semi-finished goods. Many Brazilian exports are semi-finished materials that US companies need for their own production processes. The tariffs will increase input costs for these American manufacturers, potentially affecting their competitiveness and profitability. The US tariff policy is unlikely to cripple the Brazilian economy. Instead, it is accelerating a long-term strategic realignment, pushing Latin America's largest economy deeper into China's orbit. Brazil's economy is better positioned to withstand US trade pressure than many other nations. It is far less open to trade than other major economies, with exports and imports accounting for just 36% of its GDP. Furthermore, its export markets are diversified. In 2024, China accounted for 28% of Brazil's total exports, more than double the 12% share destined for the United States. This gives President Lula significant leverage and reduces the coercive power of US tariffs. For over a decade, China has been Brazil's largest trading partner, and the relationship extends far beyond simple commodity trade. The US tariffs are acting as a catalyst, strengthening ties across multiple strategic sectors. From 2023 to 2025, China was the largest exporter of Brazilian soybeans, beef, and cotton. In March 2025, Brazil exported a record 15.7 million tons of soybeans, 75% of which went to China. In energy, China accounts for over 40% of Brazil's oil exports. Between 2007 and 2020, Chinese investment in Brazil's oil and gas sector totaled $66 billion. Technology and automotive. Chinese electric vehicle manufacturers such as BYD and Great Wall are investing heavily in Brazil, taking over former Ford and Mercedes-Benz factories. Chinese electric vehicle imports to Brazil tripled between 2023 and 2024. Infrastructure. China is investing in Brazil's ports, railways, and logistics. State-owned COFCO is building a large export terminal in Santos, and a transcontinental railway connecting Brazil to the large Chinese-built port in Chancay, Peru, is being planned. Strategic minerals. Brazil's rare earth exports to China tripled in the first half of 2025, demonstrating China's efforts to diversify its sources of strategic minerals amid global trade tensions. Finance. In March 2023, the two countries agreed to settle trade in their respective currencies, the renminbi and the real, bypassing the US dollar. In July 2025, Brazil announced plans to establish a tax advisory office in Beijing. This deepening integration is a conscious strategic choice. As President Lula stated during a visit to China, China needs Brazil and Brazil needs China. Together, we can make the global South respected in the world like never before. The US decision to impose a 50% tariff on Brazil is a significant geopolitical miscalculation with far-reaching consequences. By targeting a nation with which it holds a trade surplus, the US has undermined its credibility as a reliable trade partner. The policy is likely to inflict direct economic harm on American consumers through higher prices for basic goods like coffee and beef, while disrupting supply chains for US manufacturers. The move appears to prioritize the political grievances of an incumbent president over the economic well-being of the American populace. The most profound impact of the tariff is geopolitical. Rather than coercing Brazil, the policy has provided a powerful incentive for it to accelerate its integration with China. This is not merely a trade diversion, but a comprehensive deepening of a strategic partnership that challenges US influence in Latin America. By investing in Brazil's infrastructure, technology, and energy sectors, and by promoting financial systems that bypass the dollar, China is building deep, resilient roots in a region historically considered within the US sphere of influence. In conclusion, the 50% tariff on Brazil is a politically motivated policy that is economically counterproductive for the United States. It is unlikely to achieve its stated political goals and will instead impose costs on American citizens while actively pushing a key regional power closer to America's primary global competitor. The episode serves as a stark case study of how trade policy, when wielded as a tool for political retribution, can generate unintended consequences that undermine a nation's own strategic interests. Leave your comments below. Thank you for watching.